Hey, welcome back, everybody. 3:14 on this Wednesday afternoon. New Jersey State Pension Fund is one of the biggest in the United States. Unfortunately, it also faces a $46 billion challenge in the years ahead. Now, one of the officials responsible for fixing it is Bob Grady. He's former Carlyle Group partner who now chairs the panel that oversees investments for that fund. He joins us now along with Bloomberg's Cristina Alesci, who's been covering private equity and its biggest backers, including U.S. pension funds. So great to have you both here.
Thanks, Joe.
Great to
Bob,
be here.
welcome. Let me kick it off. How do you fix this pension fund? How do you make up for that shortfall? It's not an easy task.
Two different halves of the puzzle, if you will. One half is obviously to try to maximize returns while appropriately managing risk. But the other half is to really look at the long-term path of liabilities. And the governor, about 2 months ago now, proposed a reform package that other states are also starting to look at this same problem, to try to just do a whole series, a couple of dozen sensible things to try to grow, to try to sort of manage the growth of those liabilities going forward. You mentioned a $46 billion deficit mismatch, if you will, between the plan's assets and its liabilities. That's today.
Right.
If nothing is done, 30 years from now, that mismatch, that deficit, if you will be $181 billion.
Which is staggering.
Which is a giant number. So we've got to start attacking the problem today so it doesn't build over time. So a few things that are just completely logical that the governor proposed. First of all, for people that have been in the system less than 25 years, let's raise the retirement age from an assumed 63 to 65. Second, for all people in the system, and this will be controversial, but he proposed to get rid of COLAs because right now the COLAs are exceeding inflation. Our inflation has been pretty close to zero, obviously, in recent periods, so get rid of COLAs. A third, in 2001 there was an increase in the that really wasn't paid for in the benefits to employees of about 9%. And consistent with raising that retirement age to 65, he said the way we'll calculate your annual benefit would be, instead of N over 55, assuming you only work to your 55, let's do N over 65, which has the equivalent effect, basically, of rolling back that 9% increase that wasn't paid for in the first place.
So these are all kind of logical. I guess what I'm thinking is, what about the investments? Do you get riskier to kind of try and make up that shortfall quicker?
Yeah, because you mentioned maximize returns, and one of the things that New Jersey...
While managing risk.
While managing risk. So one of the things that New Jersey was contemplating doing is boosting its allocation to alternatives, right?
Yes.
And I'm just wondering, when you do that, you're obviously increasing risk, and you're only talking about a 30 to 50 basis point increase in returns,
maybe or
right?
maybe not increasing risk. First of all, for a plan as large as New Jersey, now worth $70 billion in assets, the watchword is diversification. So we're a very, very diversified plan. We have about 20% in domestic stocks. We own 1,250 domestic stocks. We have about 20% international stocks. We own over 1,000 international stocks. We have about 30% in fixed income. Sort of normal allocations, 40 in equities, 30 in fixed income. We do have up to 9% in what I would call inflation-protected categories, both TIPS themselves, but also real assets, a new category wisely created by the plan a couple of years ago. And then, as Bill Clinton might say, it depends what you mean by alternative assets, because it's not all one thing. It's actually 4 different categories.
Right. There's
it's hedge funds, it's private equity, it's real estate, and it's this category I mentioned, real assets. Now, in hedge funds, for example, you would say, well, does that drive up the risk? What we're looking for in hedge funds as we invest is non-correlated assets. We're looking for things that evince very, very low levels of correlation with the public equity markets.
Such as?
Well, such as market-neutral hedge funds. There are a whole bunch of people with strategies that are both long, short, and they're specifically looking to be not correlated with just a long-only equity strategy. There are other strategies that we're involved in, too. For example, some people have event-driven hedge funds. I would say right now, one thing that you could predict should happen in the next few years is a wave of M&A, in part because the equity markets aren't available to small-cap companies anymore. That's a longer discussion which we can talk about because of Elliott Spitzer and Sarbanes-Oxley and a whole lot of other things. But and meanwhile, corporations are sitting there with $2 trillion in cash on their balance sheet, a 50-year high. I do think they're going to be buying up these smaller companies. I do think they're competing, frankly, with the private equity firms, which also have a lot of dry powder.
Right, which actually brings us to the next question, which is, what can we expect from private equity returns, since you wear both hats as an investor and as a manager? So what can we expect from returns if there's so much competition for these deals? It's driving the prices for these deals up. So can investors expect lower returns from private equity because of that, or is it?
Well, there are cross currents. You're right. There is, I think, more competition than was the case in, say, 06, 07, 08 between private equity buyers and strategic buyers. But on the other hand, the LPs got a little calmer, and so the size of funds came down. So commitments to private equity have come down. Commitments to venture capital have come way down. Venture capital fundraising, was $100 billion in '99 and 2000 per year. It's been about $30 billion a year for most of this past decade, and now only about $2.8 billion was raised in the fourth quarter. It looks like it might be, half that, $15 billion. So there's a bit of a shakeout in both private equity and venture capital, which means they'll have less money to invest, which hopefully will put some downward pressure on deal prices. But you're right. If you talk to my colleagues in the private equity business, their biggest complaint is prices are too high, hard to buy things.
We just scratched the surface, so come back, please.
Okay. I'm sorry. I wanted to say more. So
we'll have you come back so you can say more. It was great. Bob Grady, thank you so much.